Michael Saylor told me, he said, like, what's the worst that can happen? The worst that can happen is I can never raise money ever again. And I'm $100 billion company growing at 60%. That's the worst, right? So with our company, with Satsuma, right, we raised enough money to buy 2,000 Bitcoin. I don't know what you put the long-term price target of Bitcoin, but in my opinion, that's about $2 billion worth of Bitcoin in 5 or 6 years of just NAV alone. Even if we never raise another penny again, 2 billion of NAV.
If liquidity is rising, Bitcoin will rise, but I think we're in that stage of the cycle where you'll start to continue to see outperformance from some of the other crypto assets. It's just the way it generally plays out. I think for the Bitcoin treasury companies, the well-managed one, there'll be like a delineation and you'll start to see sort of a divergence.
Bitcoin's bull market doesn't look like the others we've seen before. And that's exactly what has Jamie Coutts, chief crypto analyst at Real Vision, and investor Mark Moss paying close attention. The old script mass retail euphoria, runaway leverage, and blow-off tops hasn't played out yet. Instead, the market feels steadier, slower, almost reluctant. They point to global liquidity as the key. Raoul Pal has often said Bitcoin lags liquidity shifts by about 8 to 12 weeks. And if you map that relationship onto today's backdrop, it suggests the move isn't done. In fact, the charts say Bitcoin likely has another strong leg higher in front of it. Moss explains that on-chain signals back this up. Metrics like MVRV and broader liquidity measures hint that Bitcoin is only in the middle stage of its cycle. Sure, we could see a sudden $30,000 to $40,000 surge, but he argues a gradual climb would be healthier and more sustainable. Coutts adds that the real danger comes when Bitcoin goes vertical. That's when leverage floods in, open interest spikes, and profits start to look unreal. Those are the hallmarks of a classic top, especially if global liquidity starts tightening at the same time. For now, though, liquidity remains supportive. No euphoric mania, no blow-off just yet. And that, they argue, is the hidden strength of this cycle. It still has room to run before the real fireworks begin. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
I mean, certainly in the last 5 years, the Sharpe ratio has been much better than U.S. Treasuries. And we can see how since the introduction of the ETFs, the volatility has really come way down. So it's like we could just continue just sort of being boring and just continue creeping higher and higher and higher, you know, maybe. You mentioned the global liquidity and some of the elasticity that's sort of diminished there. Real Vision, Raoul talks a lot about global liquidity flows and sort of this potentially 8 to 12 week lag that Bitcoin might have to that global liquidity move. And so when you look at this global liquidity move right now and then adjust for this lag, I mean, it looks like there should still be another big leg up in front of us.
Yeah. I mean, the problem with using the lags is that markets are non-stationary, so it'll change over time, but directionally it should play out. Unless there's something fundamentally different about this asset that we're not aware of and that it's not tied to, you know, the increase in marginal new units of currency in the financial system, which I don't believe to be true. So the problem is that Twitter has attached itself to this chart. I think it's been the most shared chart of 2025, and it's fixated on the lags. You know, Raoul said this many times, and I would certainly say it as well. It's like, if you're trying to invest on one chart with one correlation fixed with a fixed timeline that's been working for the last 2 years, then you're gonna come unstuck.
Yeah.
But yeah, you're right. Like that the divergence between the two is expanded, and it's not just M2, which I think is the most shared sort of version of that. It's total global liquidity. Right. So you know, you're looking at central bank balance sheets, you're looking at the impact in the shadow banking market and everything else. Yeah.
So when you look at that, and to your point, certainly don't just focus on one indicator. But if you look at that plus a handful of other indicators that are commonly used, like MVRV scores, for example, or even if you want to look at Fibonacci lines, which I don't really put a lot of credit towards those things. But you look at some of these NRPL scores or whatever, it does sort of look like Bitcoin is maybe halfway through its cycle. Like from a Is it expensive? Is it cheap? You look at the M2 lag. If you look at, again, these types of indicators, you've mentioned that, from a static time frame, like October, November sort of peak from a time frame, but from like I said, all these on-chain indicators, et cetera, it looks like maybe we're like halfway through. And so again, that's from a static view. Now we could see Bitcoin go on a $30,000, $40,000 rip, which would then put it to the very top of the peak real quickly, which then maybe does make me think, well, maybe it does hit that M2 lag. We do pop up. We do end up magically right in November here at the top of cycle, right?
Yeah, I think the best thing for Bitcoin, if you're in it for the long haul, is that you get sort of a moderate increase, because it's when Bitcoin goes parabolic that you generally find the crescendo top, because that's what encourages over positioning, increased leverage, which always gets unwound. And if it's unwound at a time when global liquidity is starting to slow or decelerate, it doesn't have to top. Global liquidity can expand well beyond a Bitcoin peak, and it has in the past. It's really about that subtle change or that rate of change. But if you have the ingredients of a parabolic rise with a massive explosion in open interest, and MVRV goes up, which is all the unrealized profit in the network, then you have the ingredients to form a top. This peak has been, we saw euphoric tops in intermediate or mid-cycle tops in Q1 of 2024, and I was calling it out then. In Q4 of 2024 again, which I was calling out again, which no one was willing to listen, because the tightening of financial conditions to the US dollar and liquidity was just not supporting it. But where global liquidity is today and where it kind of needs to get to stop anything from happening is still a fair way away. So I think that the trend itself is looking, it's tired because it does rely on liquidity, but we haven't seen a euphoric parabolic rise that would just take the wind out of the sails for the rest of the cycle. If liquidity is rising, Bitcoin will rise, but I think we're in that stage of the cycle where you'll start to continue to see outperformance from some of the other crypto assets. It's just the way it generally plays out. I think for the Bitcoin treasury companies, the well-managed one, there'll be like a delineation, and you'll start to see sort of a divergence. If you look at all the Bitcoin treasury companies in terms of percentiles of their MNAVs, you'll see more of those companies start to drop into the bottom percentile, and that bottom percentile in terms of MNAV will go from 1 MNAV today or less down to 0.8 or less as they get sort of more and more distressed or out of favor. And so there'll just have to be a consolidation. And we'll look at this period in the next cycle and see much less companies that are pursuing this strategy. And you'll start to see the winners more clearly affirmed, I guess, by the market, because, you're involved in this space and you know that, I would imagine, I'd like to actually find out from you what you think about this, but there's definitely going to be some acquisitions scooping up going into sort of the next bear market and consolidation in the space, because you'll basically have the opportunity to buy Bitcoin at a discount. So I think that's how I sort of see it playing out.
I mean, certainly it's going to play out that way, but we're talking very broadly, right? So certainly there will be companies who find themselves at a point in the road where they can't raise any more capital. They're trading below net asset value, and someone's going to come along, make them an offer to give them an equity deal buyout, and they're going to take it. So of course that's going to happen. Will that be the majority? Probably not. Not this early in the game, in my opinion. So a couple things. So number one, these are equities. So just because the equity price drops, the market cap drops, and they're below 1 times MNAV, net asset value for everybody, so they're keeping up. Why does that mean I have to sell my Bitcoin? So what?
They're just not buying.
Yeah, so what, right? Like I have my business, I'm generating revenue, I'm going to keep buying Bitcoin, I still have my Bitcoin, so what? Michael Saylor told me, he said, what's the worst that can happen? The worst that can happen is I can never raise money ever again, and I'm a $100 billion company growing at 60%. That's the worst.
Jamie Coutts and Mark Moss argue that if you followed the standard 4-year Bitcoin cycle model, the market should already be topping out. Historically, halvings have marked the rhythm. Prices climb, peak, then crash into a bear. But this time, things don't line up so neatly. Bitcoin has already multiplied about sixfold from its 2022 lows, so the explosive easy money phase has passed, yet they say there's still space for further upside. The real force at work, they explain, isn't the halving, its liquidity. Global liquidity moves in 3 to 5 year waves, largely tied to sovereign debt cycles. The halving has coincidentally overlapped with those liquidity waves in previous cycles, which made it look like the halving alone drove Bitcoin's rhythm. In reality, liquidity is the fuel, and it hasn't run out yet. Both analysts believe liquidity will likely get another push into late this year and early next year. That should extend the bull market into the first half of next year, keeping prices elevated rather than immediately plunging into a bear. The peak is hard to pinpoint, but based on these frameworks, they argue we haven't hit it yet. Bitcoin's cycle, they say, is evolving beyond the old 4-year script. Let's get back to the interview.
If people are following sort of the stationary models for crypto, then we're at peak of cycle, right? This is the time which Bitcoin would typically peak and would be sliding into a bear market sort of by next year. Now this cycle has been very, very different. We can talk about like what a cycle actually means in crypto, because it does mean different things to different people, but also people are now hypersensitized to the word cycle, and therefore everyone talks about it. Where I think we are though, is we're in the later stages of the bull market. Like, this is not where easy gains are made anymore. Bitcoin is 6x from the lows in 2022. But I still think there is more upside. And the reason why I think there is more upside for Bitcoin and for other crypto assets is that, we've had a extraordinary or a very different period coming out of the last bull market, which was really just a hangover from the excess liquidity that was pumped into the system because of the COVID madness. So the fallout obviously has been higher consumer price inflation, but also a deficit in the US and in most Western governments that has exceeded the growth in economic growth. And therefore, you've got a problem with too much debt, not enough liquidity, a business cycle, which is incredibly important and ties into the crypto cycle, that has been more or less been in sort of, has flatlined, hasn't really been in an expansion phase. It's the longest period where the business cycle has remained, or the ISM has remained under 50. That has changed the duration of the cycle. And therefore, we're at a point now where it's clear that the business cycle is starting to improve. Corporate earnings are, dramatically improving. Positioning in risk assets, if you look at equities, is not euphoric. And you've got this problem that the central banks are, patently aware of, that they have a system which is incredibly indebted, where the amount of debt has increased way more than the liquidity that they've allowed back into the system through interest rate policies or through central bank balance sheet activities. And I think that gives us a liquidity impulse and upsurge towards the end of this year and into next year. So my view is that this market extends into sort of the first half of next year, and then it's sort of anyone's guess as to where the peak might be. But we at Real Vision have the frameworks basically to outline probabilistically when things are going to turn.
So we got the introduction of QE. We got all the central bank balance sheets have been overly extended, levered up at this point. And it looks like, in my opinion, previous to 2008, they sort of allowed the markets to sort of deleverage, which they tried to do in 2008, and things fell apart too fast. And they said, oh, we can't do that, right? We levered the system back up. And since then, 2019, obviously 2020, the banking collapse in 2023, anytime there's been even the slightest hint of some sort of deleveraging, the banks collapsed in 2023, it took 6 days to get a bailout. And it just seems that now the system has become so levered up, but not just that, the appetite, the willingness to allow any deleveraging has also changed. The amount of tools that they've implemented to prevent that deleveraging have been radically changed, especially since COVID. And you mentioned the amount of deficit spending and debt spending that's really driving the market.
If you think about cycles being driven by liquidity, yes, the Bitcoin halving definitely drove cycles, but it's become less and less important. But it also just happened to coincide with this cycle, the liquidity cycle, which tends to operate in a 3 to 5 year time frame. Yeah, everyone says it's like 4 years, but really, why is it on a 3 to 5 year time frame? It's because it's based on the duration of the debt at the sovereign level.
Right.
Now, sovereigns will fund themselves through an array of different maturities, but we're sort of the average has been around the sort of 3 to 5 period, and that's just what has looked like a 4 year cycle, which was attributed to the Bitcoin halving cycle. I think it was always there. If you go back to 1998, there was a recent report which I think that you got as well, which I published, was looking at sort of what happened in 1998 around LTCM. The central banks have always been willing to step in, but the events were so infrequent, or relatively infrequent as compared to today, that they were generally slower. I don't think there's the same, like the risk models that I have built around Bitcoin, they don't scream euphoria. We had euphoria in sort of Q4 of 2024. So look, if the cycle ends, we'll all look back and say Q4 was really the top in the on-chain data and all the risk metrics, in the same way as May of 2021 was really that was the real top of that cycle, because it took out all the momentum. And so yes, we went higher, but there isn't really in the most recent run up to 125,000 in Bitcoin. There wasn't screaming euphoria. One of the reasons maybe we can get into as to why there's been sort of, I guess, momentum destruction underneath the surface of the price has been the marginal buyers being Bitcoin treasury companies and the ETFs peaking into that cycle, and then basically declining quite rapidly since then. So that is the critical swing factor for Bitcoin, but that will follow the liquidity cycle. So if liquidity picks up, the ETF buyers will return, the Bitcoin treasury companies will see maybe not falling MNAVs, maybe expansion, who knows, but their capacity to buy and become, and get more involved in buying Bitcoin will increase. I think what's offsetting that hypothesis, Mark, is that you've got now, in the early stages, spot buying only. And you had the uniqueness of the hard cap as well with the declining inflation rate. Mm-hmm. That was perfect for parabolic rises, especially when it was just the plebs, us buying it. Then as the network evolved, and I guess more sophisticated players,
the futures, the options, etc.,
suppressing the volatility. So I even look at the research that I do. I look at the elasticity of Bitcoin to changes in liquidity, which is, anyone who says there's a perfect metric or a perfect correlation in financial markets doesn't understand financial markets, because markets are non-stationary. But at least historically and still today, the relationship with liquidity is statistically extremely significant, but it is moderating over time. And so looking at sort of just the last couple of years, Bitcoin's elasticity to the changes in liquidity is less this cycle than in the last cycle, but not by a massive amount. And just where we are in the liquidity cycle is typically when you start to see a real uptick, and therefore the elasticity generally expands also during this period, but more so in the same sort of scenario from previous cycles. So I just look at that and I think, okay, you've got suppression of volatility, and you've got just the maturation of the market, and the sensitivity of the asset to the drivers of the price starting to decline. So I am in the camp that we start to see KGARs moderate over time. But it's going to be interesting because there will be explosions of volatility in and along the way.
Unusual stability in Bitcoin's rise is signaling something different this cycle. Instead of the usual frenzy where new money rushes in, leverage spikes, and traders chase parabolic moves, what we're seeing is more measured. Analysts argue that the real driver here isn't just the halving narrative, but the global liquidity backdrop that continues to act as fuel. If that liquidity wave extends into the next year, Bitcoin's run could carry much further than the traditional 4-year model would predict. That shift has major implications because it suggests suggests the market is maturing into something less dependent on retail mania and more tied to the same forces that move bonds, equities, and currencies. But that doesn't erase the risks. Liquidity eventually turns, and when it does, those sharp reversals that define Bitcoin's history can reappear quickly. What makes this moment compelling is the balance. There's still room for upside before the dangerous stage of overextension begins. For serious investors, this isn't about timing the exact top, but about recognizing how the rhythm of the cycle is changing. So the pressing issue becomes, if Bitcoin's growth is now being dictated by liquidity waves rather than having cycles, how should traders and long-term holders adapt their playbook before the tide inevitably shifts? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.